Well, the old property market is well and truly over. Increasingly around the country, we have a multi-speed property market. We have Melbourne and Sydney. We've got the enormous boom in WA on the back of the resources and commodities boom. And then we've got the rest of the country pretty much treading water throughout 2006. Into 2007, we expect pretty much more of the same, although we are likely to see Melbourne and Sydney pick up a little bit and possibly the edge come off the WA property boom. Interestingly, a common set of economic variables, interest rates and inflation in particular, now have a very varying effect throughout the country as far as the performance of the residential property market is concerned. As if the shifting sands of varied residential property markets across Australia aren't enough, we're also seeing a change in the pattern and volume of supply and demand in residential property markets. It's no longer a case of people thinking in terms of seasons, spring, summer, autumn and winter, for their buying and selling decisions. We're now looking at more calendar-based property markets and a much more even spread of supply across any given 12-month period. The traditional spring rush has now given way to a much more even spread of transactions right across the year. Turning to interest rates and inflation and how they're likely to pan out in 2007 and the rest of 2006, I think it's fair to say that the market has pretty much factored in this third interest rate rise already. So whilst we're unlikely to see too much of an impact in terms of people's buying and selling decisions, it is possible that into 2007 purchasing limits may be a little bit more restricted because evidently the cost of borrowing will be a little bit higher. Hopefully that interest rate rise and the successiveness of the interest rate rises will maintain the stability of the residential property market, and it's this tinkering around the edges that will in fact give the market longevity and stability in the much longer term, and that's really good news for investors. One of the problems with interest rate rises is that investors tend to react to them in a fairly knee-jerk fashion, particularly if you see more than one in rapid succession. So to get our mindset right is really, really important as investors. Let's make friends with the fact that we are, over the life of our investment lives, going to see interest rates rise and fall and stay the same. Understand too that when you invest in residential property, that's a long-term investment. So plan for interest rate rises, factor it into your calculations and just ride the wave. Most importantly, when you're in the residential property market as an investor, stay put. Don't trade in, don't trade out, because it costs a lot of money to do that. Buy the right asset in the first place and plan to hold it for the long term. We're continuing to see very strong demand for prestige properties in excess of $1.5 and $2 million. This is because there's always underlying demand for it that is well and truly in excess of the available supply. And we expect this trend to continue into 2007 unless something very unpredictable, an X factor for example, comes in to change that particular momentum. We're seeing rental yields in the residential property market firm for the first time in quite some years. This is good news for residential property investors, particularly because we've seen capital growth a little bit more moderate in that period of time. A lot of investors who've stayed out of the market because yields have been a bit low are starting to trickle back in, and so into 2007 we think we're going to see increased demand for residential investment properties from the investor market. There's been a lot of speculation about the effects on the residential property market of the government's new $1 million top-up of superannuation. People are wondering whether in fact we're going to see a mass exodus of residential property investors. I don't believe that's the case. I think what we will see though is a slightly different profile of residential property investor, with a lot more people with self-managed super funds looking to buy their first or second investment property in the super fund with the help of the government's top-up provisions. So we'll see a different kind of residential property investor come into the market in 2007. But this comes with a salutary warning. We're seeing something of a trend emerge with many apartments in high-rise towers being reassigned for low-cost public housing purposes. If that trend that already exists in Melbourne is replicated elsewhere in Australia, we could well see a whole new wave of marketing to investors for apartments with guaranteed rents and tax incentives as the proverbial carrots being dangled for them to enter the residential property market. If that happens, be very wary. Never choose your assets on the basis of tax incentives or guaranteed rents. Make sure you buy quality assets with strong potential for capital growth and hold those assets for the long term.